Hi, I'm Vishnu Srinivas, and welcome to Hawkeye, a podcast featuring prominent business professionals and their views on topics impacting businesses and economies around the world. Make sure you rate, review, and subscribe. Joining me today is Professor Viral Acharya. He is the professor of finance at the New York University Stern School of Business. Thank you so much for taking the time to speak with me today.
My pleasure, Vishnu. Looking forward to the interaction.
Awesome. So would you like to give a short introduction about, I guess, your background and your role?
Sure. So as you just mentioned, I'm a professor of finance at New York University Stern School of Business. I mostly do my research in the area of banking and financial crises with a special focus on credit, liquidity risk, their amplification. But I focus not just on why financial firms and the financial sector as a whole might fail by over leveraging itself or by herding and correlating its risks. But I also try to understand what role is played by regulatory and government distortions in sort of giving these incentives to the financial sector to lever up or to herd or correlate and then have sort of spectacular collapses every now and then. Over the last 10, 15 years, I've been sort of also quite interested in the issue of sort of what happens after a crisis. Why aren't banks recapitalized in time? How does the limited fiscal capacity of governments play a role in their kicking the can down the road and recapitalizing their insolvent financial sectors? And then whether these have persistent effects in the form of zombifying the economy, where banks evergreen or keep rolling over bad loans because they never have the capital to recognize the losses on their balance sheet. So I've studied this in the context of Europe notably, but also in the context of India. I'm now studying a little bit of this phenomenon of zombie lending for the United States as well. And my research tends to be a mix of analytical or theoretical work and empirical, often both. Because I like the constant back and forth between theory and empirics, because you build theory, then empirics don't support them, and then you go back and you keep tweaking your theory based on that information that you just gathered from the data. I had the good fortune during 2017, January to July 2019, of being at the Reserve Bank of India as a deputy governor. I was in charge of monetary policy, foreign exchange operations, managing the liquidity operations, running the statistics and the research department, and then on and off a few other functions at the central bank. It was a very exciting and exhilarating experience, both professionally and personally, and I'll be happy to touch a little bit upon that at some point as well.
Awesome. Yeah. So actually, that's kind of where I'd like to start, because obviously, you, as you said, you served as the deputy governor of the Reserve Bank of India. And I'm curious, broadly speaking, what were some of the lessons and or biggest challenges you encountered in your time as RBI governor in terms of policy planning and implementation?
Yeah, so firstly, I was only a deputy governor, so I assume that the challenges for the RBI governor are far, far more severe than those are for a deputy governor. Let me mention three things. First, for a while, I thought that being the deputy governor at the Reserve Bank was probably the best job in the country, because you had a fair bit of executive powers within the portfolio that you were running, especially if you had the trust and the confidence of the governor, which I did when I started out. But you don't have to be like necessarily the public face, with doing all the political interactions and all the back and forth and compromises and managing optics and all that comes with it. So I thought in a way it was fascinating. I love working with teams of people and kind of learning from them, giving them direction, shaping their careers and agenda. And so I thought that was like very, very fascinating part of it. Second, what was the most fun part? The most fun part was that as I was saying, my research was sort of more in the area of banking crises, banking regulation. But the portfolio that I had, which is the typical portfolio that an economist runs at the Reserve Bank of India, is in the area of monetary policy, inflation targeting, foreign exchange operations, liquidity operations, open market operations using Government of India securities and so on. So I thought it was very nice because I learned a lot of macroeconomics, inflation, as well as actual market interventions, which of course as an academic, I didn't have as much experience with. So that was quite nice actually. But at the same time, I was a little bit of the front end for trying to resolve the non-performing assets crisis in India because of my prior experience of research in the area of banks and banking crises. And I'd done a lot of advisory work with the Federal Reserve banks in New York, with the European Systemic Risk Board, which is sort of like an advisory body on systemic risk to the European Central Bank and the European financial system as a whole. I'd been involved in some capacity at Bank of England. So there was a wealth of experience that I could bring to the table on the bank non-performing assets resolution issue. So it was just very rich. The whole menu of what I could do at the central bank was very rich. And what I found very satisfying were the speeches that I wrote when I was there. I wrote most of the speeches on my own, of course, with some inputs and corrections from others. But I had like a model, which was to first explain the issue, then give it an international context, because many problems that India faces are also being faced or were faced in the past by other countries. So I used to give a little bit of historical context, talk a little bit about how did they try to solve the problem, or did they not try to solve the problem, and then what were the consequences, what worked, what did not work. And then I used to come back to the Indian setting and try and make up advocacy for a policy proposal in the end. And I found that this way of organizing the thought process, the advocacy, worked quite well. Even though one might think that the political system or the bureaucracy is not interested in academic arguments, I thought that was actually not the case. You had to lay out things in a manner that they could relate to. You had to talk a little bit beyond India so that they got a grasp and an appreciation for the problem beyond the immediate context. Because sometimes when you are knee deep in solving a current problem, you can't actually look at it objectively. And you have to think about the same problem being seen somewhere else to get like an objective take on the issue. And I found that while not always successful, it was certainly a good way to promote policy and get the rest of the system behind you to support you and move it forward. Sometimes what you do with these speeches is just plant an idea, the seed of an idea somewhere, and someone else then carries it. And that's perfectly all right. You're not looking for credit or that you always have to implement the correct ideas yourself. So that, to me, that was like the most fascinating part, being able to shape the public dialogue, the policy, the reform agenda in real time, in a manner that actually leveraged my past experience as a researcher, as an advisor to the central banks, and yet sort of very much in the Indian context that we had. What was the most challenging part, and that's the third point I wanted to come to. I think the challenging part is to kind of draw the right line as to when do you keep the central bank sort of autonomous operationally and technocratically from the political influences which in India abound. There's no shortage of people wanting to get what are supposed to be kind of independent institutions to work along with the present day government to help them achieve their sort of short-term objectives of each term. Clearly, this happens in all countries of the world. There are some compromises being struck every day in each part of the world. But there's a sort of a delicate balance that you have to maintain of when the request that is being put to you is too much, or it's not in the interest of the long run of the country. it's not in the interest beyond the current term of the government. And then you have to draw a line. Sometimes the central banks are explicitly constrained by rules precisely so that they don't act with discretion all the time and give in to these political compulsions. To use an Indian analogy that I used in my A.D. Shroff memorial lecture, which was one of the sort of maybe perhaps the most noticeable speeches I gave while there, was that the governments are playing like a T20, whereas the central bank is meant to be playing a test match. And so, sometimes you have to just bear out in a session, just survive, and not always be trying to win every single session, because sometimes that could involve a lot of risk and a lot of costs. And you could end up losing the test match if you try to win every single session rather than like sometimes just steadily going through some difficult sessions. So that was the most challenging part. I don't know if I got it right, but at least I felt I gave the situation the sort of due merit that it deserved at each point of time. We did strike a lot of compromises, but some of the demands were we thought one too many. And then we had to open it up for public debate. We did. It did come at a cost, professional cost to some of us. But I still think it was absolutely the right thing to do, because I think some of these exits, such as mine and of some others, they helped actually ensure that the primacy and the importance of the issues that we were batting for were not just sort of completely lost. I hope that they are there at the back of their mind. For example, the central bank is back again in trying to rein in inflation in the last 3-4 months. And I'm not saying I'm responsible for it or something, but I think everyone who's trying to keep the inflation targeting framework and its importance for the macroeconomic stability is playing a role in anchoring that institution and giving it the solidity that it deserves to have in interest of long-term health of India.
Absolutely. And that's where I'd like to go next, because you obviously mentioned the importance of empirical versus theoretical. And obviously, the RBI is taking an aggressive approach towards combating inflation. Most recently, I think it raised the repo rate by 40 basis points. So this is kind of like a textbook monetary policy solution. But are there underlying factors in the real world that could undermine this kind of plan?
Yeah, so I think in my view, in a lot of emerging markets, but maybe increasingly even in advanced economies, what's undermining the inflation targeting frameworks is the very large amounts of government debt and the need for the central bank to help the governments roll over their debts at low cost. Of course, they are also doing it explicitly by offering their balance sheets in order to purchase the government bonds in the form of quantitative easing programs. Quantitative easing got introduced in Western economies after the global financial crisis. Emerging markets have been doing it for decades prior to that. Emerging market central banks have always been using their balance sheets in order to ease the government borrowing programs, lower the long end of the yield curve, and hope that there's some stimulus either via the government or otherwise in the process. So I would say in my book, Quest for Restoring Financial Stability in India, which is sort of built around my speeches, I have a prelude chapter which was sort of written after my term, which is called as Fiscal Dominance, a Theory of Everything in India. And the point I tried to make there is that not just the monetary policy, but even bank regulation, the foreign exchange policy, the policies to regulate the government of India markets, the FX markets, they are all geared in one way or the other in India to basically support the fiscal situation of the country. India is perennially running large fiscal deficits. Government is borrowing a lot, trying to crowd out the private sector in the process for its own borrowings, direct the savings to itself rather than to the rest of the world, or at least the rest of the country. And so the fiscal dominance, in my view, is the primary challenge that the central bank has to face every single day in sticking to its mission. So in the context of the current inflationary environment, of course, the post-COVID situation is very special. The government had to take on more deficits. First, the tax revenues came down, and then it had to undertake some support programs. The central bank not only maintained negative real rates, but also pumped in a huge quantum of liquidity in the economy, just the way United States has done. In some ways, I would say without a fiscal stimulus of the size of United States and without private demand and investments being as strong as in the United States, India finds itself on inflation front in a very similar situation. Food inflation is very high. Fuel inflation is high. Core inflation, which is the sort of a more generalized measure of inflation without food and fuel, has been above target of 4% in India, more at the upper end of the tolerance band of 6%, now for almost 3 years. And now the other impulses are pushing it even higher. Wholesale price inflation has been above 10%. It's now close to 15%. There has been a wave of concentration of firms in the Indian industry, and that means they have the pricing power to push the wholesale prices now into the retail prices if they want. So I think it's an interesting scenario. Certainly inflation is high, and I hope that the central bank, which has just turned in the last few months, in my view, with some delay, perhaps because of political compulsions or otherwise, or maybe growth compulsions, but usually the two are the same. But it has finally turned around. It's focusing on inflation now, and I hope that it runs the natural course of bringing the inflation down, not just to the upper end of the band, but to the mandated target level of 4%. Inflation, as per the legal mandate of inflation targeting, has to be maintained at the level of 4%, or in the band of 2% to 6% while paying attention to growth. Prior to the recent turnaround in the monetary policy, 6%, which was the upper end of the band, seemed to have become where the inflation was allowed to sort of be at. And it's only when the inflation surpassed even that level that the central bank has embarked now finally on raising rates and withdrawing some liquidity from the system. But to cut a long story short, in the end, what's going to be the biggest challenge to pushing through rate hikes in India? It's going to be the fact that it's going to increase the cost of government borrowing. It's going to increase the cost of financing for some ministries. The ministries, the bureaucrats, the finance ministry will at some point come together and try, either through backdoor conversation or front door conversations, have conversations to push the central bank towards either slowing down the pace of interest rate hikes, or keep pumping liquidity into the economy, or keep giving relaxations to the banking system so that they can still keep expanding credit even while the central bank is trying to bring down inflation. These are the pressures that the central bank will have to try to fend off and ensure that it can remain on the path of bringing inflation down to ensure external sector stability. The biggest risk that people don't realize is that when you lose inflation credibility slowly as a central bank, the main problem you can face is that if there's an external sector shock, there isn't the credibility that the central bank will bring inflation down. Countries like Argentina and Turkey have faced this repeatedly, partly because their central banks keep getting compromised by the governments in charge.
Right. And what we're also seeing right now is the 10-year bond yield in India has reached its highest figure in 3 years. And do you see this as going hand in hand with the higher oil prices, obviously, that we're seeing? And consequently, does the tight oil supply make this more of a long-term issue in your view?
Absolutely. So, oil is always a big problem for India. It's a compound problem because it immediately increases the fiscal deficit and simultaneously increases the current account deficit because India imports most of the oil. So it produces exchange rate depreciation at the same time as it expands the fiscal deficit. So the twin deficit problem, oil is a very big contributor to it. I would point out, though, that the Indian inflation right now is more generalized than just the oil. It's of course there in food as well, because international food prices since the invasion of Ukraine have risen very, very sharply. But as I was saying, the core inflation in India was at 6% and gradually inching higher even prior to the invasion of Ukraine. So I think the underlying impulses were already there, and now new inflationary impulses have come to the table. And the government of India borrowing costs will rise primarily because the higher inflation means that there'll be a higher expectations of interest rates rising down the line as well. Now, interest rates were already in the level of 8, perhaps it even touched 8.25% during 2018, when oil prices had again risen very sharply from about $40 per barrel to $85 per barrel. That time, the Iran sanctions didn't finally take shape, and therefore the oil prices came down substantially. Right now, there is far less clarity that oil prices will come down from $110 or $120 per barrel in a systematic manner. Of course, there's uncertainty around the war. A lot of the supply is being taken out as a geopolitical retaliation against Russia. And importantly, I think, the climate change mitigation policies which are in place have meant that fossil fuel supply or capacity is not being built up in response to higher prices the way it typically used to. Because there is uncertainty about the transition risk. What kind of regulations will come in place? Will fossil fuel assets become stranded down the line if climate change policies are adopted at a fast pace? So all this means that there are structural factors which are pushing oil prices to be higher. The war is pushing food prices to be higher. And there's a certain movement away from globalization. We are seeing some balkanization of trade as we speak. It's unfortunate, partly because it's going to raise inflation by preventing terms of trade to be exploited via sort of freely flowing globalization and trade between countries. So my sense is inflation seems to be moving structurally higher. And I think this means that a government such as Indian government, which typically does not maintain any fiscal capacity to counter-cyclically adjust, means that it will have to expand its deficits further. That would add to the borrowing costs, but also the expectations of inflation and rate hikes will also add to the borrowing costs. One last point I would make here is that the oil situation in India is quite peculiar because either the government asks the oil marketing companies to pass through the costs of imports to the consumer. In that case, the oil marketing companies can maintain their margins, but then the inflation experienced on the ground is high. And then through the interest rate channel, the borrowing costs will have to rise. If they don't do this, then the oil marketing companies have to squeeze their margins, maybe even make losses. But then that means fiscally, the government is absorbing the losses of not passing through the oil prices to the consumer. The only way this can work well is the government has maintained some fiscal capacity to counter-cyclically absorb this shock. But government of India is always running a very large fiscal deficit between 5 to 10% at least. And, in a situation after pandemic, it can even become higher. So this means that the standard fiscal stabilization or an automatic stabilization that occurs through fiscal capacity for strong country balance sheets, that doesn't happen in case of India. We are also not a hard currency. We are not a safe haven currency. So we don't benefit from a reduction in interest rate costs when global uncertainty rises, So these are some complexities of an emerging market, especially an oil importing emerging market that India has to constantly contend with.
Absolutely. I think India's unique position makes this different from, I guess, how other countries are going to deal with similar issues. Where I want to shift to next is the US, and specifically, there's been lots of tension right now over the economy. Do you foresee a recession happening on the rise, or simply a general growth slowdown as interest rates are expected to rise again?
Yeah, I think that's it's sort of hard to guess these things ahead of time. But if the stock market corrections and the bond market corrections are anything to go by, they seem to be bringing the news that a recession might be on the way. Now, whether it happens in 6 months or 12 months, I would say is anybody's guess.
Mhm.
Uh, it seems the demand is still quite strong. Inflation on ground will probably still have another 3 to 6 months at least to run by, because people make plans ahead of time in terms of their house purchases, planning holidays, acquiring autos. If you are planning to get a home, once you move in, there's a second round of expenses that comes after all that. So as the interest rate pass through happens with some lags of 2-3 quarters, eventually the demand will cool down, in my view. And now then that's a question of whether that's the demand contraction is sharp enough to bring about a recession, whether in 6 months' time or 12 months' time. I'm personally putting the recession as still the baseline outcome, at least between the 6 to 12 month horizon. To me, the real question is whether there might be some financial market accidents or turmoil along the way, because the froth in the equity and bond markets was just too strong because of extraordinary negative real rates and the huge surplus or glut of liquid dollar liquidity in the system. There's also a lot of exuberance, maybe even a bubble, if one could call it, in assets like crypto and so on. That's coming down very
Yeah.
hard as well, maybe even faster than the other markets. All of these wealth effects, as investors realize that their wealth is getting eroded at a very fast pace. Maybe it was just paper money to start with. How quickly there's a consumption response to all this needs to be seen. It appears that with a 15% equity market correction from the beginning of the year, we are sort of approaching the levels that are typically seen in lead-ups to recessions. The bond market spreads are widening quite sharply, not just for junk-rated bonds, but also for investment-grade paper. Again, to me, this is a sign that rollover costs for companies will rise as well. That is something that they will have to factor into their future investments and hiring decisions. Many of them are sitting on cash, and that might give them some comfort along the way. But if both equity markets are coming down sharply or bond market costs are rising sharply, consumer perceptions for expenditures in future are coming down. Generally, all of these to me are, they bode, the signs that that a contraction might be coming sometime soon.
Definitely. I think the contraction concerns are valid, but I guess this is where my last question is sort of heading. What's surprising is that we're seeing in conjunction strong labor market performance, at least on the surface level, because we saw more jobs in May added over expected, as well as wage increases. So I guess help me unpack how is a recession still a possibility when on the surface level, the labor market seems to be doing quite well?
Yeah, I think when you look at the labor market, one thing to remember is that COVID has created sort of a little bit of an imbalance between where labor is available and where the job demand is. And there are multiple factors. There's sort of the so-called great resignation that a part of the labor force has left. There's a lot of working from home, but I think in many parts of the country, I think women are still not fully back into the labor force. So that's something to keep in mind. Second, I would say certain sectors are growing much faster than the others, and they are the ones where necessarily the skills are not available. The services are coming back up because of pent-up demand, but immigration has slowed down very significantly. And so some of those service jobs are not clearing that well either. So I would say, to me, the fact that the wages are rising so sharply is not just a sign of heightened demand, but is also a sign of heightened demand intersecting with the specific supply side shock that COVID has produced at the same time. But at some point, the high inflation will have to be combated because it's becoming endemic and generalized in the basket in the United States. My experience of on-ground inflation seems in double digits rather than, say, the 8% that we are measuring. The Fed has no choice, I think, to bring inflation down by raising rates and withdrawing liquidity in a sharp manner, maybe sharper than they had initially hoped for. The consumer perceptions are negative for future expenditures, even though the current expenditures, maybe because those adjust with a lag, are still sort of buoyant. To me, therefore, I think we have to look at market signals to understand where things are going, rather than necessarily extrapolating real data from the expenditures we are seeing in the last quarter or the last 2 quarters. The market data is more forward-looking. I think that's the main point I'm trying to make.
Yeah, absolutely. Great stuff, Professor Acharya. Thank you so much for taking the time to speak with us today. I really appreciate it.
Thank you, Vishnu, for this interaction, and all the best to all of you at Michigan Ross and everyone in the audience. All the best with your careers, and I hope you can navigate the high interest rate and inflation environment very comfortably wherever you decide to join for your jobs. All the best.